Welcome back to the channel.
Glad to be back.
Today, we're diving into the world of options trading.
Specifically those building blocks.
Uh,
Long calls and long puts.
right.
A great starting point for anyone looking to level up their investment game.
So before we get into the nitty-gritty, let's break down the basics. What are options exactly?
Options are like, they're contracts.
Okay.
They give you the right, but not the obligation, to buy or sell a stock. At a specific price, we call this the strike price, by a certain date, the expiration date.
Makes sense.
You're essentially making a bet on whether a stock will go up or down.
So two main types, calls and puts.
Exactly. Calls let you buy the stock, puts let you sell.
Gotcha.
Think of it this way. You think a stock's going up, you buy a call.
Uh-huh.
Think it's going down, buy a put.
But why not just buy or sell the stock directly?
Well, options provide something pretty powerful, leverage.
Ah, I see.
You control more shares with a smaller investment.
So greater potential for profit?
Yes, but also for losses. Got to remember that.
Right, of course.
Yeah.
So what can you actually do with an option before it expires?
Well, you have three options, so to speak.
Right.
You can sell it to close your position, hopefully for a profit.
Most common approach, I imagine.
Definitely. It avoids the whole, exercising the option thing.
Right.
Second option, let it expire worthless, happens if the stock doesn't move the way you thought it would.
And your loss is limited to the premium.
Exactly, the premium you paid for the option.
Right.
And finally, you can exercise the option, meaning you actually buy or sell the stock at that strike price.
Less common.
Much less. Most traders prefer the flexibility of selling.
Let's try to illustrate this. Imagine you have $5,000 ready to invest.
Okay.
You believe a stock, currently at $50, is going to climb to $60 in the next month.
All right.
You decide to buy call options with a strike price of $55.
And those calls are costing you $2 per share, or $200 per contract. Each contract represents 100 shares.
So with your $5,000, you could buy 25 contracts.
If the stock hits $60, boom. Your options are worth $500 each. That's a profit of $7,500.
Nice. But what if the stock stays below $55?
Then your options expire worthless. You lose the initial $5,000.
The other side of the coin. You think the stock will drop to $40?
You'd buy puts then, maybe with a $45 strike price, again costing $2 per share.
Same 25 contracts.
Stock falls to $40, same $7,500 profit as the call scenario.
But if it stays above $45?
You lose your $5,000 premium.
Wow, so the potential gain with options is way higher than if you just bought the stock itself.
That's right. The stock would have only yielded a $1,000 profit. Either way, that's the power of leverage.
Pretty incredible, but I'm guessing there's more to consider.
Oh, absolutely. Strike price, expiration date, the premium cost, the stock's volatility, all those things factor in.
A lot to think about.
But grasping the basics of long calls and long puts sets you up well for navigating this exciting, potentially lucrative world.
For sure.
A solid foundation is key.
Absolutely.
All right, so now let's dig into some important concepts related to options trading.
Okay.
Specifically, how options relate to the current price of that underlying stock.
Got it.
We've got three states here: in the money, at the money, and out of the money.
Right.
So an option is in the money if exercising it would, make you money, result in a profit.
So for a call option, that means the stock price is higher than the strike price.
Exactly. And for a put, it's the opposite. Stock price is lower than the strike.
Makes sense.
Then we have at the money. This is when the stock price is, pretty much equal to the strike price.
So no immediate profit from exercising it.
Right, but it could still have value, because the price could move in the future.
Potential there.
Exactly.
And out of the money.
That's when exercising it wouldn't be profitable.
So for a call, stock price is lower than the strike.
And for a put, it's higher.
Got it.
Understanding these three states is super important for figuring out, how profitable an option might be.
And how its price might change.
Exactly, as that underlying stock price moves up and down.
Now, what about the option's total value? I think it's called the premium, right?
Right, the premium. And it's made up of two parts.
Okay.
We've got intrinsic value and extrinsic value.
Intrinsic value, that's what the actual profit you'd make if you exercised it right now.
Exactly, the real tangible value.
So for a call, it's the current stock price minus the strike price.
And for a put, strike price minus current stock price.
Gotcha. What about extrinsic value?
Sometimes called time value, this is the part of the premium that's, beyond the intrinsic value.
So it's like potential future profit.
In a way, yeah, it reflects the potential for the option to become profitable based on, time remaining, volatility, and market demand.
Ah, I see. So the longer you have until expiration, the more time for the stock to move.
Right, and more time means higher extrinsic value.
Makes sense. And higher volatility means bigger price swings, so that could increase the extrinsic value too.
Exactly, because
Yeah.
those big swings could push the option into, that profitable zone.
So to calculate extrinsic value, you just subtract the intrinsic value from the total premium.
That's it.
This intrinsic and extrinsic stuff, it's important for options traders, right?
Absolutely. It helps you see if an option's a good deal or not.
Overpriced, undervalued.
Right, so you can make smarter trading decisions.
Like, if you think a stock's going to be more volatile than the market expects.
You might buy options with high extrinsic value, hoping their price will jump as that volatility increases.
Makes sense.
Now, let's talk about two biggies that really affect an option's price over time:
Okay.
implied volatility and time decay.
These are crucial for understanding how options behave, especially as they get closer to expiring.
Exactly.
So implied volatility, what's that all about?
It's often called IV for short, and it basically reflects what the market thinks will happen to the stock's price.
Like how much it's going to move up or down.
Right, it's the market's consensus on how volatile that stock might be.
So high implied volatility means big price swings are expected.
And that usually means higher option prices.
Makes sense. Those options have a better chance of ending up in the money.
Exactly.
But low implied volatility, well, that means less movement is expected.
Leading to lower option prices, of course.
Now, implied volatility doesn't actually tell us which direction the price will go, right?
No, just how big the move might be.
I see. And this is influenced by all sorts of things.
Oh yeah, things like earnings reports, major news, overall market trends, all that plays a part.
Okay, so that's implied volatility. What about time decay?
Time decay, sometimes called theta, it's all about how much value an option loses every single day as it gets closer to that expiration date.
It's like a ticking time bomb.
In a way.
Why does this happen?
Well, options have a limited lifespan, right?
Right.
So as time passes, the chance of a big price move in the stock decreases.
Especially for options that are out of the money.
Exactly.
So time decay is bad news for option buyers. Their options just losing value over time.
Right, but it's good news for option sellers. They've already collected that premium.
Makes sense.
And here's the thing. Time decay speeds up as you get closer to expiration.
So those last few days or weeks are crucial.
Exactly. The decline in value really ramps up.
So both implied volatility and time decay, super important for options traders.
Oh, absolutely. They can make or break a trade?
They really affect pricing, especially as expiration approaches.
Right, so you have to consider them both when making decisions.
Okay, now let's move on to another important aspect of options trading, the Greeks.
The Greeks are like, they're these metrics. They help traders understand how different things affect an option's price.
Things like price changes, time, volatility.
Exactly. They give us insights into how options, behave in the market.
Now, do we need to be experts in the Greeks to trade options?
Not necessarily for basic trading, but it's definitely helpful to have a basic grasp of them.
Okay, so let's start with delta. What does that tell us?
Delta, it's denoted by the Greek letter LA, and it measures how much the price of an option is expected to change for every dollar the stock price changes.
So it's basically how sensitive the option is to the stock's movement.
Right. That's a good way to put it.
So for call options, delta is positive, somewhere between 0 and 1.
Meaning that the call option price generally goes up as the stock price goes up.
And for puts, it's negative, between -1 and 0.
Meaning the put option price usually goes down when the stock price goes up.
Interesting.
And you can also think of delta as like the probability that the option will end up in the money at expiration.
So a call option with a delta of 0.6 has a 60% chance of being profitable.
Roughly, yeah.
Now, this delta thing, it changes depending on whether the option is in the money, at the money, or out of the money, right?
Right. For at-the-money options, delta is usually around 0.5 for calls and -0.5 for puts.
So they move about half as much as the stock price.
Right, for small price movements anyway.
But about as an option moves further in the money.
Delta gets closer to 1 for calls and -1 for puts.
Because they're more likely to expire in the money.
Exactly.
And what if it moves further out of the money?
Then delta gets closer to 0, less chance of expiring in the money.
Makes sense.
Now, after delta, we've got gamma, another Greek.
And gamma, what does that measure?
It measures how much delta changes
Okay.
As the stock price moves, like it tells you how much delta will shift if the stock jumps $1.
So high gamma means delta's going to be bouncing around a lot.
Exactly. The options price becomes more sensitive, more dynamic.
Especially for those at the money options, right?
Right, where delta can really swing back and forth as the stock price moves.
So traders use gamma to, like, adjust their hedges?
Yeah, to keep their portfolio balanced. And gamma is not like the same across all options.
Yes. Oh.
It's usually highest for those at the money options, then kind of tapers off as options get further in or out of the money.
Makes sense. Now, what about theta? We talked about that earlier with time decay, right?
Right, theta, that's all about how much value an option loses each day.
As it gets closer to expiration.
Exactly, and remember, all else being equal here.
It's a big deal for option buyers.
Absolutely, it's working against them. That value just keeps ticking down.
But good for sellers.
Right, they've already got that premium.
So theta's highest for at-the-money options, and it speeds up near expiration.
You got it.
Okay, next Greek. What do we have?
We've got vega, denoted by the Greek letter.
Vega, what's that one measure?
Vega measures how sensitive an option is to changes in implied volatility.
Ah, so it tells us how much the option price will change if implied volatility moves by 1%.
Exactly.
So options with high vega are more affected by changes in volatility.
Makes sense, right? If the market expects bigger price swings, those options become more valuable.
And traders use vega to, like, anticipate big events.
Yeah, things like earnings announcements, they often cause volatility to spike.
And vega's highest for at-the-money options, right?
Right, and it goes down as the option moves further in or out of the money.
Okay, last Greek. What's left?
We've got rho, the Greek letter.
Rho? This one's about interest rates, right?
You got it. It measures how much the option price changes for a 1% change in interest rates.
Okay, so how does that work?
Well, rho's usually positive for call options and negative for puts.
So higher interest rates are good for calls.
They tend to slightly increase call prices, yeah, and decrease put prices.
But rho's impact isn't as big as some of the other Greeks.
Right, especially for those short-term options.
Okay, so we've covered the Greeks. Those are some pretty important metrics.
They are. They give us a lot of insight into how options behave.
Now, thinking back to our example of buying calls and puts with that hypothetical $5,000.
Remember, this is just a simplified example to illustrate the concepts.
Right, of course. So we started with buying call options, hoping the stock price would go from $50 to $60 in a month.
We bought calls with a strike price of $55. They were costing $2 per share or $200 per contract.
And with $5,000, we could snag 25 of those contracts.
If the stock hit $60, each contract would be worth $500, giving us a $7,500 profit.
Not bad. But if the price stayed below 55,
those options expire worthless. We're out the whole $5,000.
Right. Then we looked at buying puts, thinking the stock would drop to $40.
We looked at puts with a strike price of $45, same cost, $2 per share.
Same 25 contracts.
If it fell to $40, same $7,500 profit as the call scenario.
But if it stayed above $45,
again, options expire worthless.
So those examples really show how options can amplify both profits and losses.
That's the leverage in action.
Powerful stuff. Now, how did those potential option profits compare to just buying or selling the stock directly?
Well, if we'd bought the stock outright in that call scenario, the profit would have been way smaller.
With $5,000 and a stock price of $50, we could buy 100 shares.
Right, and if the price rose to $60, those shares would be worth $6,000, a profit of just $1,000.
A big difference.
And it's the same story with the put scenario. Short selling the stock would have also given us a $1,000 profit.
Assuming we could even short sell it.
Right, exactly.
So options have the potential for much bigger returns.
But remember, leverage cuts both ways. Higher risk, too.
Sure.
Now, before you jump into options trading, there are a few things to keep in mind.
Okay, like what?
Well, first, the strike price.
Right, that's got to align with how you think the stock's going to move.
Exactly. In the money options, where the price is already favorable, they're more likely to stay profitable.
But they cost more.
Right, and out of the money options, they're cheaper but riskier.
Gotcha.
Then you've got the expiration date. How long do you want to give the stock to make its move?
Short term for quick changes, long term for gradual movements.
Exactly.
And of course, the premium, the price of the option.
Higher premium, higher potential reward, but also higher potential risk.
Right. Got to weigh those carefully.
Absolutely. And don't forget to figure out your break-even price.
That's the point where the trade starts making money.
Right. It's important to know where that is.
So let's talk pros and cons of buying calls and puts. What are the upsides?
Well, one big plus is defined risk.
You can only lose what you paid for the option.
Exactly. And then there's the leverage we talked about.
Control more shares with less money.
Right, and you can profit in both rising and falling markets.
Very versatile.
They are.
But what about the downsides?
Well, there's time decay. Got to be aware of that.
That option's losing value every day.
And you could end up with a total loss if the option expires worthless.
Ouch.
And options trading, it's not exactly simple.
It can be complex.
It takes some knowledge and experience to do it well.
So any advice for beginners who are just getting started?
Absolutely. Start small. Don't risk too much until you get comfortable.
Oh, okay.
Stick to the basics like buying calls and puts.
Simple strategies.
Right. Set clear goals for each trade.
Know your profit target and your max loss.
Exactly. And practice with paper trading before using real money.
That's always a good idea.
It is. And remember, options trading, it's a journey.
A learning process.
Exactly. Be patient, keep learning, and you'll get there.
Great advice. Thanks for breaking all this down for us.
Happy to help. Options can be a powerful tool. Just got to approach them with knowledge and caution.
Absolutely. That's key for any investment strategy.
Couldn't agree more.